Okay, what's going on, everybody? Can you guys hear me in the chat loud and clear? You guys should be able to see GBPJPY monthly chart on your screen, watermark of the pair, the time frame, the prices nice and clear, the dates at the bottom. You guys can hear me nice and clear as well. Got the microphone right here. Okay, sweet. So I'm just going to be jumping right into it. People can obviously re-watch this as you wish. But basically, what we're going to be doing, what I'm going to be doing, is giving a full fundamental and technical breakdown of GBPJPY, a timeline of events that took place. I've done this before on my channel. Like there's a GBPJPY timeline webinar, but it's probably like a year and a half ago or something like that. And I'm just going to be telling you guys the fundamental factors impacting this and what is driving everything to the potential further upside to come. You guys can't hear me? I think it's all good. So let's just jump right into this. GBPJPY, trading a currency pair. That means real world fundamental impacting factors include central banking, as they're the cartels of the currency, geopolitical issues, real world economic events, economic data, market psychology, as at the end of the day, the market is created and designed to be essentially making money and generating wealth for the small percent at the expense of the large percent. So we're going to be looking at all of this as we start from the monthly time frame on the higher time frames and work our way down to the intraday time frames, giving some price projections of what I expect to come and why. Okay? So, for those of you who do not know, when we're going to be looking at the timeline of GBPJPY, we're going to be giving a full breakdown from 2008 to current period of time now, looking at very key fundamental impacting factors that have changed the price movement of this pair and why, and looking at very key technical, historical repetition, as well as very well-defined price points of interest that we can see have held some consistency throughout the years, and we can rely and depend on this information advantage as we project further trades to come. Okay, so let's start out over here where we had an initial rally to the upside in the early 2000s where the pound against the yen was relatively strong, but then we had one of our major fundamental catalysts come into play that started driving the price of GBPJPY all the way from 250 down to 120. Now, for those of you who do not know, this was, of course, your global financial crisis of 2008 that was triggered, of course, from the US institutional perspective, but had major ripple and wave impacting effects on global financial markets. So what this did was bring mass market fear, which takes away demand out of your risk assets and risk currencies, where currencies such as GBP, Euro, the Canadian dollar, and so forth, Australian dollar, New Zealand dollar, these are all currencies that are part of your risk asset class when you're looking at your basket of currency pairs. Then your currencies such as the Japanese yen, US dollar as the world reserve currency, and Swiss franc, and some of the main ones we look at, those are of course your basket of safe haven currencies. So we had this fundamental catalyst that caused a massive liquidating of buy positions and far more sellers in control due to the information advantage changing of the global 2008 financial crisis, bringing mass market fear. This leads to a order flow shift and change in market sentiment where you have more demand in safe havens, less demand in risk currencies, right? And at the end of the day, you're looking to trade a currency pair right now where you have the British pound, a part of your basket of risk currencies, against the Japanese yen, which is a part of your basket of safe haven currencies. So you can see what's very interesting is this monstrous excessive downside that conveniently comes to this price point of interest until we have a period of economic recovery years later. So the global financial crisis has its large term impact. You can see as sellers liquidate positions from these historical lows printed at 120 flat, which around 120 to 125 on the higher time frames is going to be a very important price point of interest. We have sellers liquidate positions, more buy side liquidity generated in the market, and as we drive lower down here, we start to create what we observe as a technical double bottom pattern, which just shows us more sellers exhausting out and liquidating positions out of the market, as well as buy side liquidity generating as we come years after the financial crisis in 2012. So we have massive profit taking and short selling from record-breaking historical highs in the late 2000s, led by this economic fundamental catalyst, which leads to a complete shift in order flow and market sentiment, as you have a huge explosion in yen value as a safe haven currency and way less demand in the British pound as a risk currency, as during this period of time we're also seeing global equity markets take a hit, so there's less investor confidence in these various risk assets. But what I want us to understand is the impact of negative fundamental catalysts, where it drives price down to, and what we see take place after that. Because as we were going into this 2012 and 2013 period, as central banks start to go and raise interest rates, and we're coming out of that 2008 financial crash, you can see we have a very, very aggressive upside move and rally from 120 all the way up until 190, right? Then we have another fundamental catalyst come into play that shifts the order flow and information advantage. Remember, from this very key demand zone to the downside, here you have historical high prices, here you have historical low prices, you had an information advantage shift here of low prices, FUD priced in from GFC, dovish BOJ, and hawkish Bank of England at this area, right? The fundamental events that led to this financial crisis and crash start to shift as you have lower prices on this currency cross and the British pound against the yen overall. But from a macro perspective, as that uncertainty and doubt gets priced in over the years and economies start to become in more of a recovery state compared to the financial crisis state, we have a more hawkish Bank of England starting to raise interest rates into this period, very similar in following suit to what the Federal Reserve did during that period, which I discussed in the gold higher time frame breakdown. But because of Bank of Japan's debt structure and their economy setup, they're already well versed in being in negative interest rate territory, and they're well known for being in this stagflation state and negative interest rate territory, so they stay far more dovish. Having a hawkish Bank of England and a dovish Bank of Japan creates a big difference between these two currency crosses, where a hawkish Bank of England and interest rate hikes is more bullish for GBP, and a dovish Bank of Japan with less fear in the market and no more demand as a safe haven currency is a lot more bearish. What the fuck just happened here? Sorry, lost control of my mouse for a second. Is a lot more bearish for the Japanese yen, right? So we have this huge extended rally to the upside until we have another fundamental catalyst come into play. The fundamental catalyst that led to this downside now, that impacted GBP individually in the UK economy, but also brought some global uncertainty and doubt to the markets. This is when it was first brought to the table, is Brexit, right? 2015, 2016, I know it's been like 7 years since we've been hearing about Brexit and the trials and tribulations, but what we have to understand is one of these first attempts at Brexit, obviously well past the 90s attempt in 2015 and 2016, this brought a lot of uncertainty and doubt to the UK economy individually, as you have the huge ties of business, infrastructure, jobs, and so forth, with the UK being a part of the European Union. So this brings FUD to UK economy and global markets. And you can see another shift in order flow with mass fear coming into the scene. But what is very, very interesting is we come to this exact same historical low in demand zone as Brexit impact ends up being for that couple of years and drags on since this current day, with a lot of the information already well known, already priced in when it was initially introduced to the markets. You can see we have a very similar pattern, even seeing this singularity across the board of price action reactions, as we have another double bottom created here with a very large potential for a rally to the upside to revisit those pre-Brexit highs. As what we have to understand is we're seeing far more buy-side liquidity generated in the market. Now, something else I want you to understand is you can clearly see, based on the technical charting and the size of the moves, that global financial crisis had major impact, right? Brexit had major impact. keep in mind, we're on the monthly chart here. So we're seeing very aggressive drops when you're looking at overall pip count, right? Now, look at this. This little blip right here, even though it was so massive in mainstream media, this little blip right here was the pandemic, right? Which was huge, 2020 pandemic and virus. But you can see in terms of market impact on this currency pair, GBPJPY, of course the pandemic led to the equity markets crashing. Of course it had very similar impact of bringing fear, uncertainty, and doubt to global markets, bringing mass market fear, seeing more demand in safe havens like the Japanese yen and less demand in your risk currencies. But what's very interesting is from a surgical price point of interest, compared to the global financial crisis, compared to Brexit, this was the pandemic impact. And when you're looking at your price points of interest, you can see you're still coming to that exact same surgical historical low price point of interest, even when you've had global financial crisis and revisitation, Brexit and revisitation, or the pandemic that impacted global economies. Right? So at the same time we're coming out of this we had the pandemic impact here, correct? And in the UK, lockdowns were also very, very shortly lived. What you had happen and take place is after that initial spike down to this very specific demanded price point of interest, we've seen historically fundamental catalysts come to this price point. When you're looking at the strength of the pound against the yen, you can see we have far more optimistic markets as the central banks come in and you start to see a huge rally in your equity markets. So what this does is as you see the demand go back into the equity markets, the Japanese yen individually as a safe haven turns flat. You have way more buy-side liquidity generated in this price sensitivity area and way more higher potential of a very similar historical bullish run, especially when we zoom in and start analyzing the price action as well as exactly where we're getting price reactions across the board here. You can see as we had that recovery in the UK equity markets, and now as we're having a lot of the coronavirus fear priced in, the lockdowns faded out, the economies open back up, recovery in the UK equity markets, we're also starting to see an interest cycle shift. The Bank of Japan still remains dovish and bearish for the Japanese yen, very similar to this 2013-2015 period. But the Bank of England is starting to become more aggressive with interest rate hikes. Is everybody following along so far? And you can also see in terms of your correlation when you're looking at the Japanese yen movement individually that it's further validated when we understand that movement of order flow. When the Japanese yen is far more bullish during those times of fear, uncertainty, and doubt, which was here, the global financial crisis, here, Brexit, this little minor spike up here was the pandemic before continuing further bearish. The Japanese yen has a lot more room for overall downside as fundamentally there's way less demand in the Japanese yen as a safe haven currency as a lot of the fear has dissipated out of the markets. And from a central banking perspective, the Japanese yen is still bearish because the Bank of Japan is still dovish, keeping interest rates in the negative, which is bearish for the currency. Right? Even when we come to do some individual Japanese yen analysis, you can see the exact same idea. It's almost the inverse of that GJ chart. And when we're coming to look at the overall structure on the Japanese yen, this was a very short-lived spike up and minor bullish market structure as when the initial pandemic fear was still relatively high. But as soon as that fear started to dissipate and the equity markets recovered and the demand shifted, and the Bank of Japan was still keeping their interest rates in the negative and still keeping an unlimited bond buying program going, still keeping their stimulus active, we've had extremely bearish market structure on Japanese yen higher time frame, with sellers just consistently printing lower lows and only having short-term pullback phases before continuing to the downside. Right? So we have that correlation factor that the Japanese yen is bearish as it has less demand as a safe haven currency, and the Bank of Japan is still dovish, keeping interest rates in the negative. We have this understanding, and I want to show you guys something very interesting here when we're looking at this rally to the upside. Remember, this price sensitivity area, very key historical low demand zone that the global financial crisis didn't break below, that Brexit didn't break below, that the pandemic didn't break below. Look at some of this technical and fundamental repetition we get in this area. And we'll zoom in even further on the weekly after, right? Almost to the exact point that bounce, almost the exact time period where you had this technical double bottom created as well, this being the pandemic, right? Look at the price action that starts to form as the buyers are in control. Of course, you're gonna have your phases of pullbacks and corrective phases as you have liquidating of positions on the intraday time frames, price setups for new monthly periods and so forth, and order flow being adjusted. But overall, you can see the movement is very similar to that recovery phase after the 2008 financial crisis, when we already had this very strong demand zone respected. We have the Bank of Japan more dovish, we have the Bank of England more hawkish. You can see the stretch of price action with just having buyers consistently print these higher highs and having minor pullback phases with a lot of potential if we continue to respect these demand zones, that you can have continued buy side liquidity in the market based on the fundamental information advantage of hawkish Bank of England and more rate hikes to come, which is bullish for GBP, dovish Bank of Japan still keeping interest rates in the negative, and not having any new fear catalysts that can bring uncertainty and doubt to the markets. Russia and Ukraine pandemic impact, very short-lived. Brexit so far, been noise. Russia and Ukraine impact, very short-lived. A lot of it is priced in. A lot of very similar information from when Russia invaded Ukraine during the 2015-2016 period. Right? Also, look at this order flow setup from this previous run. I want you guys to pay attention to this piece of market structure here. Okay? We understand the fundamental information advantage during this was bullish, just like the fundamental information advantage here has been bullish. If you go look at any of the higher time frame webinars on GJ on this channel, any of the market updates, if any of the OGs in the chat know, ever since this pandemic crash, all I've been primarily trading is GJ buys, pullback buys, breakout buys for intraday trades. Of course, as a scalper, you're going to be adapting to some more of the market waves and like potential pullbacks that can be days or weeks long. But as a swing trader or as an intraday trader, you're primarily sticking with the fundamental information bias that we stated of hawkish Bank of England, more recovery in the UK equity markets, dovish Bank of Japan, and so forth. And I want you guys to look at this. You can see here for this period of time, you had GJ consolidating between specific highs and lows, creating a very strong consolidation in demand zone for a period of time until you had a very strong breakout out of that zone with more buyer order flow generated in the market from this liquidity side zone here, new highs printed by buyers, then had a pullback to revisit that price sensitivity area, failed to break before continuing higher. Right? So far, what we had take place with such a dovish Bank of Japan, who announced an unlimited bond buying program months ago, keeping interest rates in the negative, as the Bank of England has been hiking rates, we saw a very similar repetition of that demand zone being respected, even though we consolidated for a period of months, having a breakout due to that fundamental catalyst, buyers printing new higher highs here on the higher time frame, now so far having a short-lived potential pullback phase as we're coming back to these previous highs in demand zone to generate more buy-side liquidity before potentially revisiting these highs and continuing higher. Even if we were to dig a little bit lower, when we're looking at like the 152s on this demand zone here, we'd still be very fundamentally and technically bullish on the higher time frames. Does that make sense to everybody? Very similar technical and historical repetition with the same fundamentals behind the scene that's causing that repetition and adjustment of order flow. Do you guys see that? Right? So, of course the market moves in waves with the constant transactions between buyers and sellers, the intraday volatility that can be induced by some short-term fear. But at the end of the day, all we've been seeing for the last few weeks here is a pullback phase and some short-term bears and a overall higher time frame bullish market structure. You don't want to start having this shift your higher time frame bias, as it's very, very normal on a pair like GBPJPY, especially when market volatility is high, to have these pullback and corrective phases, which is just buyers liquidating positions from new high or previous high price points, pushing price down as sellers provide that exit liquidity to more favorable buyer demanded price points to reinvest into the market, which is more all algorithmic and system-based trading, to extend price higher and continue your overall trend. Because that fundamental information advantage is still at play. We're still having a more hawkish Bank of England. We still have a more dovish Bank of Japan. We still have that potential for that historical, technical, and fundamental repetition. We still have buyers consistently printing higher highs as well. Right? Does that make sense for everybody? Also, now to break this down even further. So, you can see here on the daily time frame, every single time we essentially had a downside move to this buy side liquidity zone, whether it was regarding a new COVID variant being discovered, Omicron, Delta, whether it was the Russia and Ukraine tensions, which brought some short-term market fear, regardless, any of the pullbacks down to this buy side liquidity and demand zone have been short-lived in the macro perspective, and as more buy orders have been collected from here, we extend into higher highs. Right? So now, what we can see is as we've retested these previous highs, a resistance turning into a support, which was just showing us we did not have enough buy side volume to break above here previously. Now it's turning into a buy side liquidity zone. Is as we're watching some of this corrective pullback market structure, if we come back to 157, 158 area and fail to break, we can start to see a lot more buyer volume into the market, starting to extend us and continuing the bullish market structure back to potentially revisiting these highs printed by buyers. Right? We have to understand that this fundamental upside move here was when the Bank of Japan announced their unlimited bond buying program, which brought a lot of impulsive buyer volume into the British pound against the yen, way more short selling in the yen fundamentally, and we had a continuation move into these higher highs. And we're still respecting overall bullish market structure and the overall fundamental information advantage to still be seeing a lot more bulls in the market. All we've been playing so far for the last couple of weeks is a short-term pullback phase, which is still very evident in the market. So when I'm overall looking at GJ here with the expectations of still seeing more hawkish remarks from the Bank of England and potential upside, with still seeing a dovish Bank of Japan, and individually the Japanese yen being extremely bearish on the intraday timeframes and higher timeframes, we've just had a short-term pullback phase from these lows here to revisit these previous price sensitivity area and last lower high where we had more sell side orders drop us down into these lower lows. Even if Japanese yen individually has a bit of a deeper pullback, it's still so bearish across time frames and fundamentally where we're still going to see more sell side orders come into the market and continue to drop us lower. The only way I see GJ breaking below this 157 price point and digging deeper into this range is if we have new market fear come into the scene. What would new market fear be? Well, if this new monkeypox shit leads into global lockdowns and becomes another pandemic, actually starts impacting economic activity, if we get new events regarding Brexit that we haven't seen or heard of in the last 7 years since Brexit's been going on, if we get military escalations with Russia and Ukraine and the NATO countries start to get involved from a physical military standpoint, those are the only reasons I could see, on top of the Bank of England turning a bit more dovish, for GBP to be breaking below 157 and coming down to the 150s. Because otherwise, there's no other fundamental catalyst at the moment that's bringing new fear, so we're not seeing any reason for a demand in the Japanese yen or strength in the Japanese yen. Does that make sense for everybody? Right? And remember when we were looking at that previous historical bullish run here, right? Remember this, now on the daily time frame. This is the 2014 period. You can see something similar where you had a very strong buy side demand zone created here, right? You had buyers consistently printing higher highs as you're having a lot of the fear, uncertainty, and doubt being priced into the market. You're fading out of the global financial crisis state. You're having the Bank of England raising rates while the Bank of Japan is more dovish. You don't have Brexit take place for another year. Nobody knows what Brexit is yet, right? You can see as we printed those significant higher highs and a lot of that fear was dissipated in the market, yes, you had this aggressive pullback phase for an extended period of months here from these highs, but you can notice the exhaustion and more buy side orders being generated and collected here, still having us continue bullish with the overall trend, especially when we break out of that corrective bear structure, right? Because the fundamentals that impact the market are always going to have the same type of impact, right? You're going to see repeating technical patterns that you can analyze and dissect and understand what's going on and why. So when you're looking at this 2014 to almost 2016 period here on the daily, where we had very large extended rallies, as soon as we could identify some of that sell side liquidity fading out of the market and buy orders being collected, you can see that pattern that takes place with a lot more buyer volume that goes to revisit those previous highs that were printed, right? When you're coming now and looking at the recent events, what the fuck do you see? Right? Of course we have this short-term bearish pullback structure as the market moves in waves, but it's still from new highs being printed by buyers. We still had an aggressive bounce from this previous demand zone and previous highs. If we get a pullback to 157s and don't break this area, and especially if we start to trade back above 160s, what can we expect to see as long as the fundamental sentiment remains the same? Right? Does that make sense to everybody? Everybody following along or no? So now, I'm dropping this down to more of the intraday time frames for trade ideas. When I'm looking at GJ, remember 150s is that very key demand zone. 157 area here is that previous high where we had this aggressive bounce. Obviously right now on GJ, we see this pullback bearish market structure from the highs. But if we drive down to these previous lows, fail to break, come back above 157.5, 160s as well, and 161, I would start to be looking to jump back in the bullish bias on GBPJPY. But the confirmation to see more GJ upside when we're looking at the Japanese yen individually here and zooming in, you can see when we're looking at market structure and price points of interest, after we had these lows printed by sellers, we had a short-term pullback phase, more sell-side orders collected that drove us down into these new lows printed by sellers, driving price lower with more sell-side volume collected in this area. What I would need to confirm for GJ buyers jumping back into the scene and not seeing a deeper pullback on GJ is failing to break above here. And if the yen also starts to turn more bearish from this bearish market structure price point of interest, we could see yen continuing its bearish structure to revisit these lows, using that correlation to our advantage and continuations back to the upside. Snowden, very good question. When is this trade idea invalid? I'm glad that you asked that, because for us as manual retail traders with the access of information and resources that we have, we don't just want to have one bias and marry one bias. We want to stay adaptive. If we see any new market fear and GJ breaks below 156, the buy side trade idea is invalidated, and what we're going to see take place is us breaking back into this range here and having much deeper downside moves all the way to the 150s demand zone before seeing any potential for further buys. So the initial buy trade idea would be invalidated in a big X here for no more buys if we're trading back below 156. If we're trading back below 156, adapt to the continued bearish pullback structure and expect us to range all the way back down to this demand zone again. Does that make sense to everybody? But some good correlation factors would be that, of course, GBPJPY trading below this daily low in 156. Also, if we have any new market fear, new Brexit tensions, new monkeypox lockdown, new COVID return, right? So if we break below there at 156, and if we see with our correlation that Japanese yen, as we watch this movement individually, is trading above 78.5, then we can expect deeper pullbacks on GJ, meaning GJ coming below these previous highs and coming down to 150s again. So the initial intraday buy trade idea would be invalid if we break below 156, if we have more Japanese yen strength, if we have more market fear. I'm glad you asked that question, because it's very good for us to have this understanding and be adaptive to both sides of the market in case our analysis becomes invalid, because we're all human beings, we can all be wrong a lot of the times, you know what I mean? But at the end of the day, what's important for us is our risk management, emotional control, and being adaptive to the markets. We can be adaptive to the markets if we have the information accordingly. So adapt to sells. What's going on here? GXY strength, new fear. Then we can expect us to come back down. This is the adaptation, right? But otherwise, I'm just going to mark off this corrective bearish market structure here from these highs. This is our very, very key buy side demand zone as well, revisiting that previous liquidity zone there. If we get pullbacks to this area, I wouldn't be a hero. I would wait for confirms like this. Don't try to be a hero and guess like, oh, it's the bottom bounce. Wait for your exhaustion confirms. Let price pull back and come back above 157.5 and even 158.5. Then be jumping back into the buys, or also the safer buys in this fashion on the higher time frame and intraday time frame. Trade idea invalid below 156, which I just explained. Below 156, deeper sells, continuations down. With yen strength, new market fear, GJ trading below 156 flat in those previous highs to the left. Otherwise, like I was showing you guys, based on the fundamental information advantage in the current market sentiment in play, what we're seeing take place right now looks very similar to that previous run. No, it does not have. That's why I gave a good question, Mr. Alex King. No, if we don't get those pullbacks, and especially if we break above this previous rejection point here, if we don't get the pullbacks, then we can just see some continuation to the upside as well, with buyers back in play to revisiting the highs. Okay, someone says 155.53. There is liquidity. There's liquidity everywhere in the market, you fucking retard. The whole how do you think the market's constantly moving? There's high frequency trading going on in transactions within milliseconds. There's institutional liquidity on the higher time frames. The market's always moving because of the volume in play, the constant transactions between buyers and sellers. I just like to take it level by level, price by price. So first area I'm going to be looking at is clearly this very specific price point of interest around the 158. I don't know what this guy's seeing randomly at 155.53, hoping we get to this wick again. Just because we had a wick there. Yeah, there's liquidity up here too. All right, everybody. I don't want to make this webinar too long. Hopefully you guys enjoy webinars like this. If you like this one, I already did one on gold yesterday. The gold one's already uploaded. You guys can re-watch that as you wish. But that's my full breakdown, some of the history on GJ, the very key price points of interest, the technical and fundamental repetition, all the way from monthly down to 4-hour and intraday time frame. Yeah, you never heard the word retard before? You guys are traders. I think you should have thicker skin than being called the name. All right, everybody, take care. Rewatch this as you wish. I'll see you all.